Well, good evening, everyone. I think I'm live. Oopsie, this always happens to me. My necklace gets caught in my glasses. There we go, so I can see. Voila. Okay, hopefully this is working very well because I don't have my dual screens, but I think it's working. So let me see if I can split the screen and be able to see the chat. Okay, that looks like that's working. All right, everyone. Well, welcome. Happy Wellness Wednesday. Oh, um, okay. I don't know what that was. I just heard a sound. Okay, sorry about that. Well, happy Wellness Wednesday. I am Mia James, and I'm your favorite financial wellness coach. And welcome to our weekly book series on the Rockefellers. It's called the book that we're studying is called What Would the Rockefellers Do? And tonight we're going to be talking about chapter seven, actually, chapter seven. So I am going to pull it up and hopefully you can hear me and see me okay. Um, I'm in a new space today, so but it seems like it's working. So, and welcome to everyone who's joining for the replay. Let me know what questions you have. Leave comments. Also, please don't forget to like, subscribe, and share. Awesome. Ooh, we got our first visitor. So I'm having people actually join me on Zoom tonight. So welcome in, Angie. So this is exciting. Yay, I have a Zoom visitor. So hey, Angie. So you're live on YouTube. Thanks for coming, Goddess Sister. Yay. Awesome. So we're gonna jump in, everyone, on chapter seven. So don't worry if you don't have the book, that's okay. I'm going to go over every detail with you. And Angie, since you're here live, if you have questions, you can definitely feel free to ask them because it's more fun when there's interaction.
Okay, thank you.
You're welcome. Awesome. All right, so we're going to jump in here. We're going to talk about tonight the types of life insurance. So, for those of you who may be new to life insurance, there's two different types. There's term and there's permanent. So basically with term insurance, you may already be familiar with this. Let me know in the chat if you're familiar, put a one in the chat. If you're still learning, put a two in the chat and ask away any questions you have. So term um, is basically covers you for a certain period, and permanent insurance covers you for the entirety of your life. And there's different types of permanent coverages. So, but term has a purpose, right? So in the book, he says that term is merely a stopgap to maximize your death benefit as you get your cash flow in order. So a lot of times, when I'm working with families, depending on what their finances are looking like, I'm able to, get them a certain amount of permanent, but maybe in order for them to get maybe a total of $1 million in coverage, we may do a stopgap and have some term coverage in there. And term can be good for things like your mortgage. If you have young children when you get your life insurance and eventually they'll complete college. So a lot of parents will get a term policy, just to take care of their kids' college, just in case, God forbid. But term is not a long-term strategy because oftentimes I ask my clients, do they plan to have life insurance? Would they like to have life insurance once that term is up? And nine times out of 10, the answer is actually yes. And so they don't really realize they weren't really taught that what happens when the term is up. And we're going to talk about that in a second. So the thing is with term, we don't know when we're going to pass away, right? So, basically, if you get a 30-year term and you're 30 years old, there's pretty much probably a high likelihood, unless you have some type of, illness, there's a high likelihood that you'll live past 60. So, in the book, he says the policyholder is betting on a death, which is their own death, and the insurance company is betting on survival. He said 98.9% of term life insurance premiums are lost. Okay, so basically, just long story short, welcome, Robert. Glad to have you here. Did y'all know only 1% of term policies pay out? So 1% of term policies pay out. So that's important to know. Let me know in the chat if you knew that only 1% of term policies paid out. Put a one in the chat. If that's new information to you, put a two in the chat for me. And for those of you who normally, okay, Angie, you know a lot about this. This is awesome. I love it. Excellent. Um, the next thing he talks about with term is he says the cost of term insurance becomes expensive over a person's lifetime. So unless you have an annual renewable term, which means the price goes up every year, for the most part, it'll be level premium. Oh, no worries. It'll be annual, a level premium, right? So let's say you locked it in, you were super young, you're only paying $25 a month for like $1 million policy because you got it when you were like 20, right? Um, Guess what? When you're 50, $1 million policy is no longer $20 a month. So it's usually about a 10-time rate increase. And more than likely, that's about 2 grand a month. Most people at that stage are either heading towards a fixed income or already on a fixed income. And at that point is no longer affordable, right? And so nobody wants to find out, you're 56 years old. In some instances, people have health changes at that time. And now life insurance is not affordable or they're not insurable because that's another important piece of the puzzle. And that's why you want to make sure you get your life insurance the younger you are and the healthier you are, because that'll keep the premiums, which is the payment, affordable for you, or at least for the most part. Um, so key difference here is low initial price, right? But a very high long-term cost. So it's important to understand about term. So now let's get into permanent insurance. So the author, I don't know why I can never remember the author, even though I really enjoyed this book. The author is all about whole life insurance, but I like to educate on everything. I've sold whole life insurance before. I've sold index universal life. I don't sell variable. I've sold term. I am not biased in any way whatsoever. I am about what is best for the person that's sitting in front of me, because everyone has different goals. That's why I explained earlier, there's a way you may want to do a hybrid because maybe based on your needs of your family needs $1 million in coverage to be able to handle all the financial responsibilities if you pass away, or when you pass away, I should say. And $1 million in permanent in coverage may not be affordable at this moment. So we don't want to tell you, no, you can't have $1 million, but maybe we do a blend, right? So that's really important is that if you don't have insurance, right? And if you're not working with me, whoever you work with, you want to make sure that they're helping you meet your needs and meet you where you are. So his big thing is whole life. And to be honest with you, because I've studied all of it, whole life, the guarantee is the death benefit. But one thing you'll notice, like if you look at an illustration, which is where you see the numbers, the um, cash value piece, which is the important piece that we've been talking about, is usually not going to be as high as with other policies. And just because it's a dividend base versus tracking an index, okay? So a dividend is like an interest payment. For those of you who are in the stock market, you understand it's like a payment based on profits. So throughout your lifetime with a permanent policy, you can use the cash value. So you don't have to pass away to use the cash value. That's something you can use now. There's tax protection, disability protection, long-term care, and lawsuit protection. So if you, God forbid, get involved in a lawsuit, they cannot touch your cash value in your life insurance. So that's important. It's also designed to remain in force until you die. And he says there's a 100% chance that we're gonna die, which we all know that, right? And so basically, most policies are designed to either last until age 100 or 120. Now, I don't know about y'all, but I'm not trying to be here for that long. But it's nice to know that if I am, that my beneficiaries will still benefit. So he said to make the payout, let's say you had $1 million permanent coverage. To make the payout, the insurance company collects money from you in the form of premiums, either monthly, annually, semi-annually, or quarterly. And they invest that money while you're alive, right? And so, but insurance companies also have to have a very, very strong cash reserve because when you do pass away, they're on the hook for that death benefit. So they have to have that money readily available. He also wants to remind, and I also want to remind you, life insurance, unless it's variable, it has the word variable in it, is not an investment. That's really important to understand. Obviously, the permanent coverages have a cash savings component. That's important to understand, right? It's like a built-in savings account, but it is not an investment. Even though it may track an index, it's not directly in the index because you'll see that in your returns, right? So that's really, really important to understand. Life insurance is not an investment unless it has the word variable attached to it. Um, if anyone has any questions so far, I'd love to take them because I love questions and chat interactions. So the cash value, if you weren't here before, it has some great tax advantages, in addition to the death benefit. And also, like I mentioned, it has that liability protection, like in case of a lawsuit. So I'm just going to read this from the chapter. He says, whole life insurance is really the only private financial contract left to us today. Unlike bank accounts, brokerage accounts, or 401ks, there is no public record of life insurance contracts. So if somebody tried to come for your assets or something like that, there's no public record. No one knows if you actually really have life insurance or not. So that's, something that you can hold privately, and people have millions of dollars of life insurance. So that's something that you can use to drive your wealth. So there's other types of cash value life insurance. One that I'm most familiar with is the universal life insurance. It's specifically index universal life. So we'll get into the differences there. Um, he says, okay, so this is where we differ a little bit. Okay, and it's okay to differ, right? He says that universal life is optimally funded term insurance with a cash value. And with this part is true. He says it has flexible premiums. So yes, so you can, for example, I've had clients where I had a client that she didn't work for several years. And because she had built up the cash value in her life insurance policy, they were able to take the premium from the cash value and her policy didn't lapse. So that's a benefit of having flexible premiums. So you can in some instances reduce or pause payments. But again, what I always advise my clients is that that does impact their cash value and death benefit. That's super important. It says the rate at which the cash value in these policies grows is determined by the insurance company and based primarily on fixed income rates. So I don't really use universal life insurance. I use index universal life for my clients. Um, and I'm gonna skip to that part. Well, he kind of mixed it all in together. The difference here is that with the index universal life policy, instead of getting dividends for your cash value, basically your policy tracks an index. Okay. So basically, here's how it works because you might have this already. You pay the premium to your life insurance company. A portion is taken out for cost of insurance because, again, when it's time for the claim to be paid out, they have to have the money. So it does cost money to actually be insured. And some people are just like blown away, like, I have to pay for that. And I'm like, yes, that's what you're paying for. You're paying to make sure that there's a death benefit there when you pass away. So a portion is saved in that sense. Then another portion of your premium goes toward building your cash value. And if you have an index universal life, well, if you have just the universal, let's just start there, it's going to be a fixed income rate. So you probably won't see as great of a returns, which is what he was saying in the book. With the index universal life, it tracks an index. So like the S&P 500, like There's high cap multi-index. There's multiple different types of indices, the NASDAQ, the Russell, and it tracks alongside. And we know that the market, typically the S&P 500 has a 10 to 11% return on average, sometimes much higher than that. So, with that being said, long story short, um, oh, hey, Jen. So, with that being said, we know that these returns are so great. And you get to take a portion of that without the risk of actually being in the market. Now, I'm in everything, okay? So I am not biased to market, insurance, or anything. I invest, I am very diversified. But I know that everybody that I work with is some people are not as, they're risk averse. So I'm not gonna, I wouldn't recommend certain things for certain people because you have to be able to handle. Like, for example, if you're directly in the market, you have to be able to handle the volatility, the ups and downs, basically. So, but in your insurance policy, let's say if the index performs well, you get the benefit. Your cash value grows. If the index doesn't perform well, nothing happens. Your cash value stays level and we try again next year. So there's some, it's nice in that sense that you don't have to worry about any losses. Now, here's the deal, and this is where he differs, and this is why I'm not necessarily going through the book. You can definitely read it, but you know, with the Index Universal Life, the problem is people, insurance agents, let me say that, are not are not designing them properly. So that's what his issue is. He's like, there's no way that, this and that is going to happen, right? Um, he says they carry unnecessary risk. If you don't pay back money that you borrow or miss a premium payment or never borrow against your cash value. This is the thing. They have to be designed properly. If you pay the minimum payment, and I tell my clients this straight up. A lot of times people, they if you don't see the value in life insurance and how it can help fund your estate and set the next generation up for wealth, or even you for wealth, because if you have this money that you can pull from in retirement, right, where you don't have to risk running out of money because you still have the death benefit, once you, even if you use your cash value, this is a game changer for a lot of people because they know that they have this bucket of money sitting on the side, but it has to be designed properly. Without the proper design, it won't work. So if, people don't want to see the value because they want to pay the minimum, the bare minimum, right? Even if they can afford more, it's different if it's an affordability thing, right? But they put in a bare minimum, you're not going to like the results. That's I always have to say that. I guess I'm probably too honest, but I'm like, no, you're not gonna like it. You just won't. You're not gonna be happy with the numbers that you have. So I just want to be honest, like, basically it's kind of like what do they say? You get what you pay for, or you get out what you put in type of thing. It's very similar in that aspect. So the last part that he talks about in chapter 7, I guess chapter 7 is more so about the types of insurance. So thank you all that are here who are actually listening because I know this is not the most fun topic then that you can be a part of, but it's important to understand, especially if you're considering life insurance or you have life insurance and want to make sure it's working for you and the needs of your family. That's the most important thing. I just want to educate and make sure you're taken care of. So Jen's question is, what number would you recommend? So Jen, there is 100 questions that I have in order to recommend a number. So one, obviously is like, what is the death benefit that you want to have? And the question about getting to a death benefit has to do with different factors, right? Like how much money do you want to have set aside to either bury or cremate you? Is there any debt that your spouse will be possibly left with that they need to pay off? Consumer debt or mortgage debt? If you have young children, any education money that you want to have available for them in the case of a sudden early death, premature death, And then any inheritance or income replacement. Because there's this commercial that I've seen where unfortunately this lady, she says her 32-year-old husband passed away. And she was thankful that he had life insurance because, when you experience, I have a friend that's a widow, we're young. When you experience something so traumatic, you may not be able to go back to work right away. And guess what? You still have to pay your mortgage. You still need to take care of your children. And you don't want to have that pressure of grieving, but now you got to go back to work. So when you put all those numbers together, right, um, that will determine your death benefit. And then from there, based on your age and your health, then we will determine how much that you need to put in order to get the death benefit that you want. The other way you can determine is if, for me, this is what I did. I wanted life insurance for long-term care purposes. So if y'all don't mind sharing in a chat, what is a reason why you would even want life insurance? If y'all can tell me for yourselves in the chat. So I'll share my example. So for me, I wanted life insurance initially, right before I knew like the ins and outs for long-term care. And you might be like, well, what is that for? So long-term care is for if you cannot perform 2 out of 6 activities of daily living, um, over a 90-day period. So activities of daily living. I always forget what's the one of them. Okay. It's bathing, dressing, toileting, transferring, continence, and eating, I believe. So if you can't perform those, right, for 90 days, and the doctor will declare you as needing long-term care. Now, there's many ways you can take advantage of long-term care. You can pay a family member if you have a long-term care policy, rider. I have a rider on my life insurance. You can have a nurse come into your home. You may have to go into a nursing home. There's adult daycares, assisted living, you name it. There's all of that. Okay. So, I have pre-existing conditions and I don't have kids. So I was like, well, if I need care, I need to make sure I can afford it. So I based my death benefit based on how much long-term care I was going to receive. So I just had one objective. Now, and I like the retirement, tax-free retirement part. Okay, so, oh, thank you, Jen. So Jen says long-term care so her family doesn't need to worry. And then, yes, and her dependents can have it if she doesn't use it all. And then Angie says she heard it's a good way to hold money without paying taxes. Absolutely, ladies. Y'all are both on point. Robert, can you type in the chat too? Let us know. Um, yes, Jen, you are right. You are right. I'm telling you, Jen, we can get you some. We just got to get back together. So I'm gonna wrap up here tonight because I'm going to do some philanthropy after this. I don't know about y'all. I love being a philanthropist and I'm living in my philanthropy life. So um, I'm gonna go do some. I know it's like late, but it makes me so happy, so I don't even mind. So a variable universal life. Like I said, I do not sell variable universal life, but I do know what it is and I do know how it works. So a variable universal life is an investment. So there's the life insurance piece and then there's the sub account. And that sub account is directly invested in the market. So um the premiums are adjustable and the death benefit is adjustable. So depending on the market, because the cash value is attached to the death benefit, if the market is going up and down, that impacts your death benefit. So if you don't understand the market or if you don't plan to actually manage um the sub accounts, you may not be happy with the outcome. Oh, I love that, Robert. That's awesome. Oh, proud, awesome dad. So Robert said he wants to increase his daughter's inheritance. Oh, that's such a blessing. She's very blessed to have you, Robert. That's amazing. Okay, so, oh, what did you just become a sponsor of, Jen? So, Angie and Robert, just in case you're wondering, so Jen is watching live on YouTube, and you all are here with me inside the Zoom. So, moving forward, you can always join me here on the Zoom, or you can join me on YouTube, and I'll have both. So, that's the VUL. Again, I mean, there's a ton of stuff in here, but that I just wanted to make sure to break down for you all what the differences were in life insurance and how, depending on which way you decide to go, if you do whole life, IULs, term, term doesn't have cash value. So that's important. So the whole point of this chapter is to make sure that you have the proper life insurance with the cash value to be able to fund your estate. So next week, we're going to be going over chapter 8, and that is about Dave Ramsey and Susie Orman, who I used to follow religiously. So I'm very excited to read this chapter. So I actually read the chapter the same week just so it's fresh in my mind. But a lot of the information, of course, I'm familiar with, but I love to hear how other people think about it and then share with you and then hear how you think about it because that's what's most important is getting you what you need. So, any questions before we wrap up for tonight? I'll take one or two more questions and then we'll call it a wrap. But Jen, I want to know what you're a sponsor of. This is exciting. I'm very curious. All right. Well, if you would like me to support you on your journey for life insurance, I'm just going to put my website in the chat. You can go here. You can work with, find my link. It'll say work with me at the top, or you can take the quiz. The quiz is pretty fun, and it'll kind of let you know what path you're on specifically for retirement. So, my specialty is tax-free retirement, cash value life insurance, as well as guaranteed lifetime income for retirees. So, I am happy to support you in any way that you need. Thank you for coming, Angie. It's so good to see you. I haven't seen you since well, in person, obviously, since December. And Robert, nice to meet you. I don't know how we if we've met before, but Robert, I'm curious, how did you hear about me? Oh, thank you, Jen. Yes, I got to see Angie's beautiful face. All righty. Well,
This is Robert. I get email from you.
oh, wonderful. Did you hear about me from where did you hear about me from?
Robert, the Black Business School.
Okay, wonderful. Yes, I am a proud member of the Black Business School. So thank you for coming.
This is hopeless. What are you guys doing? We're trying to figure
All
out. You're
right.
welcome.
All righty, y'all. Well, you have a wonderful night. Thank you for joining me. It's been a pleasure to serve you. Good to see a beautiful face, Angie. And I hope to see you all next week. Invite folks, people who you think need to know this information, because information is free. So why not? All right, good night.